Good afternoon, ladies and gentlemen. It's November 29th. The trading month, has come to an end for November, putting in an ominous candle over here known as the Hanging Man candle, which could spark reversals. We're going to talk about that today on today's stock market report, where we navigate the financial markets through the lens of technical and inter-market analysis. Let's go ahead and get right into it. All right, everybody, welcome back to the show. We're going to quick look here at a market snapshot, how everything performed for the week, and kind of give you some more insights into this. So here is some of the bigger markets assets. We have IWMQs, Nasdaq Composite, SPY, Dow Jones. We have oil, and then down here at the bottom we have the 10-year yield, the dollar, and some bonds. And what I want to call out here is you have a lot of green on the screen from a week-to-date perspective. We had small caps really take back off to 5.58% on the week, being up 12% on the year. So half of the year's gains were done just last week. Some could say, right? Qs were up almost 5%. The Nasdaq Composite up about 5%. SPY was up 3%. So it's just a massive, massive week. And if you look down at the bottom of the list, what were the two assets that were down? It happened to be the dollar and the 10-year yield. We'll get into that momentarily. As far as the 11 sectors that make up the S&P 500, what led the way? No surprise, consumer discretionary and technology. This is the wants, right? Think of this XLY as things that consumers want, whereas consumer staples are more the things that people need, right? So when you have the things that people want outperforming the things that people need, it's typically more of a risk on sentiment. Okay, I'm going to continue on and point here at this falling dollar and falling yield on the week. And I want to show you that via this chart here. We have the S&P 500 down here, the 10-year yield and the dollar. And what I'm pointing out here is that when you have basically a falling dollar, a falling yield, it's typically quite supportive of the S&P 500. And you could see in recent trade, the dollars have been kind of coming off. The 10-year yield came off, and well, that helped the S&P 500. So one might say is if you know the direction of where the dollar is going to go, that can really help determine where, risk is going to be in these markets, risk on or risk off, and saying that with the 10-year yield when it moves with it. And I wanted to show you these interesting charts here. This is an analog. The orange line is actually the dollar from basically October of last year to right where it's currently at. And then the blue line is 2016 to the 2018, the first month of 2018. Now, why those dates? The reason for those dates is because in 2017, right, 26 going into 2017, that was Trump's first term, right? 2017 was the first term in office. And I found this correlation to be interesting because this really helped me get ahead of what might happen this year if the dollar were to kind of follow that same path. And in 2024 and 2025, you can see that the orange line has been following the blue line very, very well. And this happens to be Trump's first term back in office. The correlation here is actually at 0.833, which is a pretty high correlation. So I'm just calling it out, right? This is not predictive by any means, but if we were to hold a strong correlation, what would that suggest that the dollar is going to do? Well, it would suggest that the dollar might bounce in and around these levels, and then going into the first month this is the first month, January of this would be 2026 that we're trying to analog, it would be a dollar falling, and that could be quite supportive of these markets. However, I wanted to go ahead and just kind of say what's a comparison of what the 10-year yield did doing the same time frame, right? 2017, 2025. The 10-year yield in 2025 is orange, 2017 is blue. And really, there's not really a strong correlation here. It's at 0.19. So I can't really use this data. However, I just want to call out that during this same time, right, the yield rose dramatically and the dollar fell dramatically in the first, going into 2018 after the first term, so his second year in office. So if this is going to be a similar take, what happens to the S&P 500? Well, if I go and pull up this chart, you can see the dollar, the 10-year yield, and this is heading into 2018. Okay, this is the S&P 500 down here. And you can see this is the dollar, right? It was falling like we already pointed out. And then this was the yield, how we just pointed out it was going higher. And you can see this going into the basically first month of January of 2018. What happened? Well, we saw with the dollar falling and yields rising, a massive squeeze in the S&P 500 that ultimately resulted in a very sharp and subtle correction in that new year, almost 12% correction, and then a lot of sideways chop since that point. And I want to just, reiterate that when you have, right, once again, falling dollar, falling yields, it has been supportive. And the flip side is true too. When you have a rising dollar, rising yields. Well, what happened to the S&P 500? This was happened to be in 2022, right? In 2022, we went through a bear market, how the, there's also, war and all kinds of stuff going on, but we did have a rising dollar and rising yield at that time. So it works in both ways. And sometimes you get these type of days or months or whatever where you have something like maybe a rising dollar, or sorry, a falling dollar and a rising yield. And, that could mean a different macro environment, perhaps potentially more of a stagflationary environment. So is this going to play out the same exact way? I don't know. I do find it useful though, because the correlation's been so strong. Okay, so let's take a look at more absolute stuff. This is the S&P 500 on the daily time frame. Huge, massive rebound over here. 1, 2, 3, 4, 5 days, basically straight up after this big down day over here. And ultimately, what are we doing? Well, we're floating around new all-time highs, and we're kind of just been in this side kind of pattern over here. Some people might call out, a break of this or, whatever. If we continue to move higher, which is typical when you close at a high of a week and also the highs of the week and the highs of a day, you can typically get some follow through. So what that might look like is potentially even going into this year or new year, getting into that 7,000 marker, because we're really kind of a stone's throw away. Just might be a little bit of a bumpy ride to get there. If we take a look at the monthly time frame, we pointed out that there is a hanging man candle. Now, hanging man candles can spark reversals. Like this one, for example, was a massive, a hammer candle. And you can even call this like a reversal, a 3-bar reversal pattern over here. And, this is basically telling you that the bulls stepped in right after all that fear. And then we had some follow through. And then we had another nice follow through on this candle. And then we had, 1, 2, 3, 4, 5, 6, now 7 months basically in a row. Now I want to call out this week, a monthly 5 EMA has been a holding ground for the S&P 500. And we came in and tested it just this last month. And I want people to just be somewhat cautious if we do start breaking down from the 6,500 and closing below that, because we have seen in past history that that's not that great of a sign. Now, going into this next month, the expected move is basically giving us a range of about this much. And we stayed well within our expected move this last month. So that would be bringing us down to and around that monthly 5 EMA. And then to and around just above that 7,000 marker. So the doors of risk are open. Now you might be wondering what happens when you close under this 5 EMA. Well, I zoomed out here and you can see we closed under it over here, right, on this month, and we had some follow through down here this month, and we had some follow through before recovering. And then over here, we closed underneath of it for the first time, and that was 2022, and we went into more of a prolonged bear market. So if we do close underneath it, the ultimate thing that you want to watch for is a quick recovery, right? If it closes down under there, it could spark to more selling, especially if it starts to turn and start a trend down. But you can see over here when we closed underneath it, we also came right back up very quickly and had a monthly close there. So it's just something to watch as far as directional trend goes. If we take a look at the Mag 7 or the big mega cap names, we'll look at NVIDIA, Apple, Google, Microsoft, Amazon. Broadcom is definitely a big player here. In fact, this big move that we saw, in this last week, I bet you anything that a lot of it was driven by Broadcom. You can see week to date, it was up 18%. And it's one of the largest market cap names in the market. So of course it's going to hold weight. In fact, NVIDIA was actually down on the week. And yes, you had Meta, Tesla up 10%, and you had Google up 6%. And this is up, 70% year to date. What I do find interesting here is that Amazon, right, it was up 5.68% on the week, but yet it's up year to date, it's only 6.3%. So we planned this as far as a trade idea. I'll show you what that looks like. And then Meta, right, it's up 9% on the week, but where is it at year to date? It's up 10%. So basically, all the performance that we're seeing so far in these assets were just this last week, and rightfully so. Why? What happens when you get massive sell-side activity? You get big bounces. In fact, this dashed line right here was last year's closing price, and this is where we started to plan for a trade idea in Meta. And Meta started bouncing, and where can it potentially get hung up at? Oh, we're starting a reflexive bounce, perhaps that year-to-date volume-weighted average price. As we're still below that, we're below a declining 50-day and a 200-day that is starting to decline there as well. Amazon came right into its year-to-date last year's closing price, this sloping up trend line, and that year-to-date volume-weighted average price. And guess what? We reflected right back, but overall pretty flat on the year. We're just dealing with some of that volatility. So it's going to be interesting to see how some of these majors play, because a lot of them have already moved quite a bit, like Google up 70%, right? Broadcom, big mover there. And then we have also NVIDIA that's still up 31% on the year as well. Let's go ahead and take a look at some of the market conditions. We're going to start off looking at the Figuring Out Money Market Sentiment Index. Today we had the close of the week, we had a 67.5 reading on this sentiment index. So it's not, incredibly, frothy to the upside as far as, extreme greed or extreme, fear taking place right now. I will show you what did it look like the last times we had a 67.5 reading. And you can see there's been many times that we've had this type of a reading. It's fairly neutral to slightly more bullish, and we've continued to go higher. Now, the last reading happened to be off a nice reflexive bounce that we saw from this sell side activity, very similar to actually, right, what we just recently witnessed in as far as the market goes. So if I pull back up the daily, so right after this big sell day, bam, we started getting to 60, those higher readings right here. Then after this, now we're starting to get one right over here. Okay, so does that mean that we're going to probably consolidate here? Well, this chart does kind of suggest that you can have a few more of those readings, but it does kind of lead into a little bit of a consolidation, a little bit of pullback. I know that this one looks obviously huge, right? But even over here is pretty big over here. So yeah, we're probably nearing that period of consolidation, but I will say that the direction of the 5-day moving average on SPY, Qs, IWM, semiconductors, biotech, DIA, they're all green, albeit because of where price came from is now the best time to buy. No, you got to look for consolidations. You look for pullbacks. Maybe if we gap up come Monday, we pull in a little bit, consolidate, or if we gap down, we'll map out some of those key levels too. Now, last week, we had a $15 expected move. This is what the market handicaps as forward-looking risk. And we've tagged our expected moves every single week this quarter, which is pretty impressive. And we closed outside of it, breached it basically twice. Technically 3 times right over here, but I would just consider that a close right at it. But these were 2 substantial breaches because one, last week was a shortened week, right? It was a holiday week, or this week, I should say, because it's still Saturday. It was a shortened trading week, and it was already a large expected move, and we moved, 25 points or so in the S&P 500 or 250 in the SPX. Massive, massive breach of that. And this is typically the type of moves that you see in the heat of volatility. But yet, it's interesting because we are back above the gamma flip line. Volatility has come in, right? We had that volatility crush, but these type of up moves are typically of that you witness in more of bear markets, surprisingly enough. So we'll see if we can consolidate and chill out a little bit. Going into next week, next month, SPY monthly, mark these on your chart. 710.57 above us, 656 below us. That's the month to date expected move for the SPY. Next week, we have about a $9.61 expected move. And as price basically came up into these highs over here, our back month, first front month volatility is starting to move once again into and around that just above 20%. The last time we were here was right over here, and that happened to mark a period of consolidation and a local top for the S&P 500. If you take a look at vol control funds, they have become sellers, right? But now they'll probably be more stable as long as we hold above our gamma flip line. And then CTAs, just this last trading day or so, this last week, I should say, have become buyers after that initial sell side activity that we saw. So the gamma flip line is roughly at about 67.20. So we are above it. This means dealers will look to buy the dip, sell the rip. So if all of a sudden we start to come back in, we have our lower weekly implied move here at 67.54, which is above our gamma flip line currently, right? So even if that was the case, we'd be below this swing low of when this rally started, VWAP, and then we'd have probably a lot of supportive area here. So if you are a buyer, start paying attention to these lower levels here. I don't know how it gets down there, if it's fast and quick, or if it goes up and then, slow, or what that might look like, but I would just be paying very close attention to the lower weekly, the gamma flip line, and this volume weighted average price to come up in here because it can act as support, and it could act as a pretty strong support. It has the potential to do that, especially after its first initial test. Now, if we start to continue to rip to the upside, we have that call wall at 7,000, and that also is in confluence with the JPM short calls. So this is where a lot of dynamic hedging could kick in, and we could technically get price to reject and or take a little bit of a breather from those levels until next quarter, which would be next year. The last chart I'll stop with here is the SPY on the 15-minute time frame. You can see as we're above that 5-day moving average, these are the levels. So going into Monday's trading session, we have our upper daily implied move, our lower daily implied move down here, and then our weekly, upper weekly and lower weekly implied zones there. So if you want to screenshot these, put them on your chart, you can do so. And if you want these levels for other assets, come ahead and check out our $16 swing trading community at $16 a month, or just buy the year, get in there for an entire year. I don't do refunds on the year, so check it out first. If you don't want to spend under $60, which by the way, is just incredibly cheap for everything that you get inside of here. A lot of it's not even, I don't even mention it here, but you get swing trading setup ideas. It's not an alert service. You get my watch list every week, right? And my tight list, which are all the stocks from the watch lists that are contracting. You get expected moves, daily, weekly, monthly, quarterly that I manually do. But then also on top of that, I now have an Asher bot, right? It's something that I built that now you can type in commands to get expected moves for any equity asset that is optionable. And then on top of that, I now have Asher alerts, which are automatic into 3 separate channels, daily, weekly, monthly. And you don't need to track them, but you can watch them, that it tells you right away that when any asset that has weekly options, which is about 650 of them, when any of those hit their upper weekly, monthly, 2 standard deviation moves, daily moves, whatever, you get alerted in those specific channels when that asset hits. It's a very, very, very powerful tool. And that alone, trust me, is worth more than the $16 a month. I know for a fact that that is worth more than $16 a month. Actually, in fact, I still plan on doing more updates and upgrades, and chances are if I keep on doing this, I'm going to have to up these prices once again. But anybody that's grandfathered in gets to keep, obviously, these prices. Okay, that's not all. You get the entire Tradie Ticks Discord bot and Discord suite, including the query channel. You get to type in all, like, if you want gamma exposure levels, that's all through Tradie Ticks that I implemented in there, so you get that included as well. Their services are typically like $70 a month. And then I give a fractal view of the market, this zones document, very cool stuff to look at from an intermarket kind of high standpoint of where things rank and as far as within certain bridge bands. And then obviously you get into the Discord, right? Everything that I post, by the way, is in the Discord channel. So if you're once you sign up through Patreon, you sync your Discord up, you're automatically given access into all of this stuff. That's all I got for you. Hope it helps out. I'll see you on the next.